Let's start accounting lesson number 4, general journal. This lesson will include number 1, definition of general journal, number 2, use of general journal, number 3, types of journal, number 4, generalizing process, number 5, feature of general journal, number 6, columns of general journal, and number 7, example of general journal. Definition of general journal. A journal is a physical record, a digital document kept as a book, spreadsheet, or data within accounting software. When a business transaction is made, a bookkeeper enters the financial transaction as a journal entry. If the expense or income affects one or more business accounts, the journal entry will provide detail as well. The main purpose of journal is to assist in the reconciliation of accounts and to assist with producing financial statements. Use of general journal. The general journal refers to a book of original entries in which accountants and bookkeepers record raw business transactions in order according to the date of events occur. A subsidiary journal in which transactions relating to adjustment entries, opening stock, depreciation, or accounting errors, etc. are recorded. The source documents for general journal entries may be journal vouchers, copies of management reports, and invoices. Types of general journal. There are two types of general journal. Number 1, general journal. General journal is one in which a small business entity records all the day-to-day business transactions. Number 2, special journal. In the case of big business houses, the journal is classified into different books called special journals. Transactions are recorded in these special journals on the basis of their nature. These books are also known as subsidiary books such as cash book, sale day book, bill receivable book, etc. The journal proper is used for entering infrequent transactions such as opening entries, closing entries, and rectification of errors entries. Generalizing process. The process of recording transactions in the journal is called generalizing. It is a three-step process described as under. Number 1, identification of account. First step is to identify the accounts which are being affected with it. Number 2, recognition of account type. Second step is to ascertain whether it is a personal account, real account, or nominal account. Number 3, applying the golden rules of accounting. The rules of debit and credit are to be applied to the accounts which are affected by the transaction. Features of general journal. Number 1, a journal is a detailed account. Number 2, records all the financial transactions of a business. Number 3, used for the future reconciling of accounts. Number 4, used for the transfer of information to other official accounting records such as the general ledgers. Number 5, a journal states the date of the transaction. And number 6, identifies the accounts which were affected and the amounts, usually in a double entry bookkeeping method. Columns of general journal. Number 1, date column. Date, month, and year of the transaction is mentioned in this column. Number 2, description. The description column is used to enter the names of the accounts involved in the transaction. Number 3, posting reference or PR. In the PR column, the page number of the ledger account to which the entry belongs is written. Number 4, debit column. This column is used to record the amount of the account debited. Number 5, credit column. This column is used to record the amount of the account being credited. Example of general journal. In this example, we have recorded 3 transactions. Transaction number 1, August 1, 20x1. In this transaction, company borrowed a sum of $50,000. We have debited cash as increasing assets and credited notes payable as increasing the liability. Then second transaction occurs on August 3, 20x1. Here we purchased office equipment on cash. We have debited equipment as asset coming into business and credited cash as assets going from the business. Transaction number 3 occurs on August 6, 20x1. In this transaction, we have purchased a vehicle, partially paying the cash that is $2,000 and partially accepting a note payable which will increase the liability amounting to $18,000. Our next guide on accounting will be lesson number 5, accounting cycle. So keep on connected and subscribe our channel.